It's great to be here today to talk about the changing role of pricing actuaries. Now, before I get started, please feel free to scroll to the bottom of your screen and enter any questions you might have throughout our session, and we'll do our best to circle back to them at the end of our time. So, actuaries, what are we? What do we do? Historically, actuaries have been labeled as either reserving actuaries or pricing actuaries, and in many instances, these roles really haven't changed much. On the reserving side, there remains the requirement that a qualified reserving actuary must sign off on a statement of actuarial opinion in setting loss reserves to make sure that carriers can meet their claims obligations. On the pricing side, there remains a business need to ensure that adequate premium is being collected for taking on the underlying risk on a particular policy. And traditionally, this involves using historical data to develop estimates of future losses. So things like loss trends, premium trends, on-leveling, loss development, loss capping, cap modeling, all of those things are covered on one or more actuarial exams, and they're still standard and a big part of our practices today. But as the world changes around us, there are opportunities for actuaries to break out of these molds and use our skills in new ways to solve these emerging business problems. So joining me today to discuss how pricing actuaries in particular are well suited to meet these challenges is Somil Jain. Somil is a vice president and consulting actuary at Lewis & Ellis. He has over 20 years of property and casualty experience from personal lines, commercial lines, pricing, reserving, cap modeling, as well as supporting insurtechs and potentially building up their first actuarial models. He holds an MBA from the Wharton School of Business, is a fellow of the Casualty Actuarial Society, and is also an active member of the CAS Leadership Development Committee. So welcome, Somil.
Thank you, Mike. I appreciate having me here. Great to be on.
Great. So I'm going to start off with the very general term technology. So I'm going to argue that technology is really impacting the insurance industry on two fronts. So first, it's really at the heart of the insurance transaction and that transfer of risk. So technology is really redefining and creating new exposures that are out there. Things that we all have heard of: autonomous vehicles, IoT devices, gig economy, drones, all sorts of those technology-driven innovations are really changing risk, what it is, how it's assessed, and how it's priced. On the flip side, technology is also impacting really the insurance industry just like other industries, and it's more operational. How can we improve customer experiences, improve profitability within insurance? How are policies issued? How are claims processed? What data is being collected to help inform future pricing insights? And so with this latter piece, really insurtechs are coming up and trying to address these types of questions. So now insurtech, we've heard that term quite a bit, but Somil, is there a standard definition of what an insurtech is?
I don't think there is a standard definition, Mike. And what I find really interesting is what it meant to be an insurtech has changed and evolved over time. I remember looking back maybe 10, 15 years ago, to be an insurtech at that point in time really meant you were starting a new insurance company, either retaining risk or not, but essentially you were at the core of it, creating a company that would write insurance, very often going after a niche market, going after consumers who are underserved in the market, and kind of addressing that. What I have seen happen since then, and especially over the last 5 years or so, is that there's a lot of new entrants into the market that are all part of the insurance ecosystem that are, in my mind, and by most definitions, insurtechs, that are not necessarily an insurance company, but they're serving the insurance market in other ways. For instance, I'm seeing a lot of data providers coming up that are saying, hey, insurance company, you don't need to ask 30 questions to the consumer every time you want to quote them. We'll give you 25 out of those 30 questions so that you now only need to ask perhaps 5 or maybe not even. And that's one aspect where these new insurtech companies are making a big impact in the industry. Other areas where I'm seeing a lot of new activity happening is claim settlement, for instance. Use of drones is really kind of one of the next frontiers that I see a lot of companies moving towards, either by providing some of the services or by providing the software that runs inside these drones to be able to take videos of roofs, for instance. And that is going to completely revolutionize the claims process. Not just, it doesn't even have to be drones. There's a lot of apps allowing people to take videos of damage to their home, damage to their equipment, damage to their vehicle, And these are all part of the InsurTech ecosystem. I think some of the core competencies still are there. There's a lot of companies, and you hear about hundreds of millions of dollars of investments going into companies. Next, buy Snapsheet. There's a lot you hear about them. I think earlier today or maybe yesterday there was an announcement from ClearCover around them getting a 200 million investment. So there's a lot of activity happening with InsurTechs. There's a tremendous amount of interest from VCs, from private equity, from SPACs lately. That is all kind of becoming part of the InsurTech world.
Wow, you covered quite a broad array of different types of services that InsurTechs can provide. So with some founders of InsurTechs, maybe they're not familiar with the insurance world, but they're data related. What are the biggest needs that you see InsurTechs having that pricing actuaries could be well suited to address?
Yeah, so I think the core function of the pricing actuary, Mike, some of the things that you mentioned earlier, kind of making sure that the prices are adequate, making sure that all of the risk segmentation is there, making sure people that have a higher propensity for risk have a higher associated premium reflecting that propensity for risk. A lot of those things kind of still stay the same. We are now just getting more interesting versions of those problems to solve. Other than that, one of there's a lot additional demand from pricing actuaries also. For a lot of the InsurTechs that I mentioned earlier that may not necessarily be providing insurance directly, their functionality ends up being helping perhaps the VCs understand, hey, if I invest in this company, how will that help the insurance world? Is there room for this? And as a pricing actuary, we can go in and say, I think there is or there not value because by incorporating this new data element or this new process, the likelihood of being able to reduce claims frequency, severity, or being able to identify risk segmentation better, that has a tremendous amount of value. And that's where pricing actuaries come in and also be able to help understand whether a future company may not even exist right now, but whether something like that could be viable and what is the magnitude of the ROI that it could produce. Some of the other areas where I'm seeing expectations from pricing actuaries change is, for example, entering the reinsurance programs, being advisors to some of the founders that are coming up and saying, hey, I have this great idea. Can you help me turn this into an actual insurance product? So we are kind of helping them get from that conceptual idea to an actual product on the street. And actuaries kind of play a role in different parts of that. Competitive analysis certainly is a big one, right? We come in and there is no data for a given carrier. There is no information that they can base their rates on. Having a sense of what the rest of the world is doing certainly informs that decision tremendously. So that's a big area where pricing actuaries are playing a big role. And related to that, there's so much work to be done around the interaction of prices with sales, with marketing, with growth, helping put together pro formas so that you understand, hey, if you take such rate activity, what is going to be the impact of that? And is that sustainable, not just from a pricing perspective, but from growth, marketing, sales perspective, and kind of almost serving as a quarterback, pulling in what the needs of the investors are, what the needs of reinsurers could be. Regulators obviously have a big role to play. One of the struggles that I see all the time, Mike, is from the perspective of an advisor, of an investor. One of their key question is going to be, well, how fast can you grow? When can you get to X million dollars in premium? And primarily because that serves as a big input into how an insurtech is going to be evaluated. And reinsurers as well as regulators may be concerned about fast growth. From their perspective, it may be, no, hold on, I want to see stability. I want to see you be able to write business and don't grow too fast, right? And I think that's another good place where actuaries can step in and say, hold on, these might be pulling in different directions, but let's find a way to resolve these two. How can we grow as fast as is reasonably possible while making sure we are managing our risk, we are quantifying the risk, we are reflecting the underwriting guidelines, and we kind of doing things sensibly. That's another area where pricing actuaries or actuaries in general can come in and add a tremendous amount of value.
No, I absolutely agree. And I think I'd like to dig in a little bit more on this regulatory environment piece, because it's definitely something that plays a huge role in our industry. And I'm curious if, do insurtechs specifically, are they struggling operating under such regulation, and are they trying to change regulation so it favors them? Because I think it's one way to message what they're trying to do to venture capitalists and investors, right? And then the regulatory environment is kind of a different animal. So are they trying to change the game?
Yeah, and honestly, that is one of the biggest surprises, for lack of a better word, that new entrants find about insurance. Very often, the people coming in are coming in not necessarily from an insurance background, but from a technology background, and that's great because we we it's hard to solve the same problems by trying the same things, right? So you have people coming in from a lot of the household technology names, Facebook and Google and PayPal, and saying, hey, we've solved some of these similar problems in fintech, in other areas. Why don't we try to solve these in insurance? Insurance is a huge market. It's you see more ads now for Progressive and Geico than most other household names, right? And people know those names. People joke about these names, right? These are the things that are part of the common lingo at this point. And insurance is a big part of what everybody is actually talking about now, which I don't think was the case 20 years ago. So these investors, as well as successful tech entrepreneurs, are coming in saying, hey, we've been successful in other areas. Can we replicate that success in insurance now? One thing that I think they kind of find surprising is the extent to which regulation impacts insurance. And not just the fact that it's regulated across whatever 54 jurisdictions, 54 separate jurisdictions just within the United States, but also that each jurisdiction looks at it very differently. And that comes as a surprise to many people. That's where experience helps, just knowing kind of what to expect, knowing what to look for, knowing where to find it. We are notorious in the insurance world, not just an extensive amount of regulation, but also what's often dubbed as desk drawer rules. And that's not something that I would expect anybody outside of insurance to be aware of and say, hey, where did that come from? So yeah, I completely agree with you, Mike. I do think that there's an element of regulation that is inherent to insurance that you don't see in a lot of different industries. Even banking, which I would consider is heavily regulated, would probably not have the same level of regulation as I see insurance companies have. A lot of it is good. There are good reasons, at least there's certainly one group of people saying, hey, insurance is very helpful, it's good. Regulation is very helpful, it's good. It makes sure that the process is fair, which particularly makes sense for a lot of the lines where some form of insurance is mandatory. So if I'm required to buy insurance for driving, it should be available, and it should be available at a reasonable cost. There's another segment of the population that is saying, hey, let it be a free economy. You don't have to worry about regulation. It's just slowing things down. And over time, since we are a capitalistic market, the market will figure it out, and you will find coverage. Don't worry about it. And that's not new. That's been going on for 50, 70 years. And it's now becoming a little bit more prominent as a lot of these insurance companies are coming in and challenging some of these assumptions that the traditional insurance companies have just taken for granted, because we've been dealing it for that long. One example that I see come up very often, Mike, is people say, hey, look at Uber, right? What Uber did to launch was illegal. Like it was fat. I think it would be hard to challenge that it was not. They violated some laws that were established by the taxi and limousine commissions, right? And they came in and they changed that over time because they were such an important force. I think insurtechs coming in are not quite willing to go that far. I don't think they're willing to say, we're just going to go ahead and do this regardless of this being legal or not. I don't really see that happening. But what I do see are a lot of people questioning the assumptions that traditional carriers have been, which is great, which I think is important. That's going to help us understand, where do we draw the line? Where are the areas that as insurers we absolutely do need to follow regulation versus where are the areas that we can kind of challenge that and say, hey, do we really need to do this way, or is there an alternate way to think about this?
Oh, very interesting. So as we also talk about technology and the different techniques that pricing actuaries use to come up with segmentation, classification, and ultimately the final premiums. There's a sense that we need to make sure that we're not coming up with something that's unfairly discriminatory. We're not having disparate impacts, and this can obviously be a major social issue. In fact, I just watched a movie on Netflix called Coded Bias, and in it discusses basically algorithms and models and things that can be used by companies, and there's no oversight about how they're getting used, and there's some disparate impacts because of the data being fed in. If the data is being fed into these models is biased, then the output could potentially be biased as well. And I think that's kind of an interesting thing, because as pricing actuaries, that's what we are starting to develop. A lot of predictive models and using all these variables and all these different data sources. So how do we go about making sure that what we're using isn't, having an unfairly discriminatory impact on the pricing that results?
Yeah, that's so that's a great topic, and one of the things that intrigued me about that movie was that they actually specifically call out insurance pricing a couple of times in that. What's interesting is that going into that, I expected there's going to be conversations around the general big brother idea. Obviously, that's not new. That's been around for a while. I expected there to be some conversation around availability for credit card, availability for taking loans for homes, to start commercial enterprises, to start small businesses, for mortgages, right? I didn't think they were actually going to get into insurance rates and also, but they certainly did. And I think there is, like many other things, right? This is another one of those situations where there are always going to be at least two opposing viewpoints, perhaps even more than two viewpoints. But certainly, to oversimplify this, there is one idea, which is, hey, it doesn't matter, right? If there is data that can support an amount of segmentation, why do you care, right? The data is there; it's always been there. We are just getting to it now. We're just finding it now, and data represents the truth. This is the best we can do, and therefore we should allow data to kind of let it decide, and it'll be the truth. Let data be the truth. It's going to tell us where we can and cannot charge. It's going to decide. It's going to help us understand how we should segment different risks, and therefore we should be able to use the data without any concerns. Now, yes, if you're explicitly modeling variables such as race, religion, sexual orientation, that's going to be a big problem no matter what, right? I don't think anybody is doing that. And they're saying, okay, great. Once we take out these handful of variables, why do you care? It's not a big deal. Again, oversimplifying this. I'm not saying that that's the crux of the argument, but oversimplifying for the purpose of this conversation. Now, if you take the other extreme end of that, the argument from that side is, well, it does matter. It's not acceptable just to run these variables without understanding where they're coming from, without understanding what's behind it. The Coded Bias movie, that had a different twist, and I'll come back to that in a second, because I think that adds another layer to this argument. But the original argument had been, it does not matter just that you don't have some of the questionable variables in the data. Is at the end, are your prices in some form or the other providing an unfair discrimination to consumers? So it doesn't matter what variables go in, but at the end, is it fair? And in the end, is it providing justifiable prices? And can you get behind them? And I think that last statement is really important, because one of the things that a lot of the new to insurance, perhaps, algorithms that are being used are getting to the point where it's increasingly difficult to explain the particular variable, and it's getting harder to say, hey, why is this the answer? Why is it the case that your algorithm produces this answer based on based on the set of input that kind of went in. I think regardless of how people feel, right? I'm not taking a view on one side or the other. I think there's validity to both pieces there. But the one thing that I think we as actuaries, as insurance professionals need to do is to be able to better explain what our models are doing and better explain why they are doing certain things. I don't think it's acceptable for us to just say, hey, that's my answer, take it or leave it. I don't think that's acceptable. I think we're not getting to the point where if we don't understand where why something is happening, where the algorithms are getting their power from, I think that's a problem. I think we need to be able to step up and find ways to identify the power of these variables and say, here's why this model is doing something, and then make an ethical choice as to, is this something that I can get behind or not? Now, we all may make different ethical choices. That's okay, and that's a different kind of debate entirely. But I think I think the question should be there. We should be able to look at this and say, is this something that I'm willing to get behind and say, yes, I support this. Coming back to coded bias, one thing that they talked about in that movie, which I thought was the idea that our models are based on past data. Now, as actuaries, as people in insurance, that's kind of the core of a lot of what we do, right? For any non-actuaries in the audience, I'll kind of throw this slight segment out there, and I'll come back, where we do pricing typically, not always, but typically in something that's called prospective rating. And what that really means is we are going to draw a line in the sand today and say, here's our rate for here's a premium for this kind of a risk. And whatever happens in the next 6 months or year, the policy period, we are willing to take on that risk given this price that we quoted today. Now, that's not always the case. There is retrospective rating, there's loss sensitive rating. We're going to take that aside for a second. But in terms of this prospective rating, now where do we come up with that premium? That premium, we don't know what's going to happen in the future, right? So we are selling a promise today that says we are going to cover you for insurance losses that happen in the future. We don't know what they're going to be. So what do? We look at the past. We look at historical data. We look at what's happened with that particular policyholder, with the larger group of similar policyholders, with other variables that define that policyholder. Now, in a simple example of personal auto, I think, and I say that because most people have a car and can relate to having auto insurance. Your driving history, your age, your gender, your credit score, that's certainly a hot button item. The kind of vehicle you drive, how much you drive, all of those certainly are variables that impact your premium, because to some extent or the other, they define your risk profile. They help the insurance company understand what kind of risk are you and what is the likelihood that you will have a claim, and if you do, how much. Now, what's interesting is the idea that coded bias kind of kept drawing on for a while was that historical data set is often biased. And if that historical data set is biased, then, well, yes, no surprise, your results are going to be biased. And you may not even realize they are biased. And this is going back to that idea that we should be able to explain what our results are. Because if we don't look for those biases, if we don't actively go in and try to understand and ask those questions, could there be bias in my data, even though I did not explicitly put in bias variables, could there still be a bias in my results? And that is, again, where pricing actually should be able to step up and say, yeah, I'm going to answer that question. It's not okay for us to say, whoops, that's what the model told us. I think we need to go in there and look into it and be able to support what our models are running, what our models are producing. I think there's so much to happen here. It's going to be a big challenge. There is a lot happening in the artificial intelligence, machine learning, data science, data analytics. There's so many different names for it. Deep learning, there's so many different names for it. They are sometimes used interchangeably. Sometimes it means specific things in specific groups. But there's so much happening there, Mike, that I think we actuaries, and as well as data scientists, and very often there's a huge amount of overlap there, need to work together and figure out some of these solutions.
No, I absolutely agree. I think as you kind of highlighted all these new techniques, the things that you're talking about, pick a name, artificial intelligence, machine learning, all those things, they require such an in-depth expertise in a particular area, as well as how they're being applied in insurance. And that's where, as you said, pricing actuaries come into play. And as we get more and more sophisticated with those techniques, I think it becomes imperative for us to fill that gap of the knowledge transfer from how it's being used and developed to translating that into something that people can understand and use and make decisions on. And I also think it's worth noting that the NAIC has a big data and AI working group as well. And they have charges in 2021 to research the use of big data and AI in insurance, evaluating regulatory frameworks for how it's going to be used and how it's monitored, auditing, and also looking at the capabilities of state regulators so that they can monitor these things as they're being filed in insurance programs. I think that's a key thing because, as we talked about coded bias, there's this idea that it's the Wild West. But in insurance, it's been regulated for a very long time. This is just a new avenue in which we're going to have to start regulating that piece and how it's being, developed. And again, that's where I think pricing actuaries can definitely slide in here and provide a lot of valuable insights.
And Mike, I'll throw one quick comment in there. Is that there's an aspect of this which is American, so to speak, right? I worked at a international carrier in the past, and we met with actuaries from around the world, and they were shocked to find much competitive data we have in the States, and say, this is great, you can use this data to do whatever you want. And as we had more conversation with them, I realized why they were surprised. The reason there's no or not sufficient competitive data in a lot of countries outside of the US is that many of them are not regulated, and certainly there are a lot of cases where the liability part of the insurance is required, mandatory, and regulated. But for example, going back to that auto example, the physical damage may not be. A lot of the optional coverages are not mandatory, and therefore they're not regulated. And what happens there is insurance pricing can often look like the way airline ticketing looks like in the United States, where depending on what day you purchase or what day you look for things for a flight, what time of the day, whether I look for the same flights leaving the same point in time, my prices can change within a day. They can change during the course of the week. And they are able to do that, and they can run tests based on that. They can have a different price for a consumer for insurance product based on what their last name is. We cannot even imagine doing things like that in the United States. And that's where there are lessons to be learned on both sides where, like I said, they were surprised by how much competitive data we had. I was surprised by how little regulation they had. And so there's always going to be kind of push and pull in that direction.
Oh, absolutely. All right, so we've talked about insurtechs and new modeling techniques and things like that. So let's shift gears a little bit and look at traditional carriers and their pricing departments. And they've been around, for potentially hundreds of years doing similar pricing. Potentially, maybe they're looking into these new techniques as well as the insurtechs are doing. Do you feel like pricing departments and actuaries in these kind of legacy companies, are they agile enough to keep pace with the insurtechs?
Okay, so that's a loaded question. I will answer that as, I'll give you an answer for kind of like the typical insurer. Right now, there's going to be many differences from this, but I'm going to kind of give you my view of what I saw in the industry as a whole. Going back 15 years ago, when originally fintechs and then insurtechs kind of started showing up, and they were infants. They were in their infancy at the time, right? The expectation from traditional carriers was, hey, this is a fad, this is going to go away, they're going to crash and burn. And they did not attempt to even kind of roll their sleeves up and see why insurtechs were coming around and what they were trying to do. It was meant to be, yeah, don't worry about it, this is going to go away. Once they understand, for example, how difficult insurance is, how complex it is, and they were not concerned. Maybe around 10 years or so ago, that started changing. And then they kind of said, oh, some of these new companies are kind of making a dent. Our agents are asking about them. Consumers are asking about them. People are starting to leave our book and go to some of these carriers. But, it's too small. We're still not going to be worried about it. Around 5 years or so ago, that dramatically started shifting. I think I guess it was maybe enough of a snowball effect that so many insurtechs were starting to put a dent, a real noticeable dent, not just for carriers but for agents. That this became a big deal in terms of whether it was as simple as going direct to consumer, right? That certainly had a big impact on agents. But then also companies that are taking a very different approach in terms of what they're rating on, what they're basing the quotes on, and kind of how quickly they're moving, how they're able to not just move through the quote and bind process, but also the claims process. And absolutely, some of those traditionally now, or again 5 years ago, started kind of noticing that and saying, you know what, we can do this. We know everything they know, and we have 50 years of experience on them. We're going to do this, and we're going to do this better. As a general rule, again, there are exceptions, but as a general rule, that did not pan out, because one of the things that I've seen with insurtech, I've worked at a couple of insurtechs myself, was that things move fast, right? Traditional insurers plan things in terms of months and years. Insurtechs plan things in terms of weeks and sometimes days, hours. Like that's vastly different. When I saw, again, this is oversimplifying the idea, but when you have traditional insurers that are used to working at that speed, at that time frame, and they come across and they say, well, we need to have large committees put together things. We need to have this approved by so many people. We need to have our lawyers look at this. We need to have a consumer advisory board look at this. They tried to solve these problems using the same techniques that have been done for many, many years, and it did not work out well, because they ended up looking like a mini version of the traditional carrier, in some cases perhaps with even more layers of authority as opposed to autonomy. I don't think that worked out well. The next shift that I started seeing, and I think this is kind of where we are now, is most traditional insurers are absolutely acknowledging that these insurtechs are making a difference. They're going to put in a dent, and they're now saying, you know what, we need to do something, and we need to take a very different approach to this. We are starting to say, when I say we, I'm pretending I'm a traditional carrier, that the same old methods that we have done are not working. And what I'm seeing now is traditional insurers saying, you know what if instead of trying to step in and recreate them, what if we actually provide them with advice, provide them with VC funding, in some cases provide them with guidance, provide them with paper, provide them with reinsurance. And what I'm seeing now is a lot of collaboration. What I'm seeing is insurtechs and traditional reinsurers working together in some areas, almost carving out a very specific entity just to provide support for technology-backed insurers, and say, we are going to keep an arm's distance, we're going to try to step in, but we are going to be able to provide you advice as in terms of being on their boards, being on the councils. We're going to provide you data, which is something that insurtechs absolutely need, and we're going to be able to provide you funding in a lot of cases. But you need to also show us results. So in essence, the traditional insurance companies, they are now becoming VCs. They're kind of taking the role of investors and advisors, and almost supporting insurtechs in some cases. It's going to be very interesting to see how this plays out, but I've absolutely seen this world and the role of the traditional carrier evolving tremendously.
Oh, that's excellent. Thank you for all of that. That's very good information. I appreciate your time. I think that wraps up the main portion that we've got today, but we'll turn to questions that we've gotten from the audience thus far. So to you, Somil, what is your opinion of actuaries getting involved in current public issues like diversity or gun violence, since we're trained to use objective facts to solve problems?
Okay, so that is, I think there is a pro and a con there. Okay, so the pro there is that we are able to look at things objectively. We look at data. We try to solve problems in some instances in an academic way. The con is we try to solve problems in an academic way. That's not how people think about problems. At the end of the day, many of them are, especially the kind of things that you talked about, they are social issues, and there is an emotional piece that's attached to these social issues. We cannot, as actuaries or as humans, we cannot ignore that emotional piece. So One thing that I would say is, as actuaries, we certainly should be able to take a data-based approach to things. So you mentioned racial injustices, you mentioned gun violence, you mentioned like a few other similar ideas. Part of the problem there is often not enough data. And when there is data, it's often biased or truncated data. So for instance, take medical studies, right? When I first learned this several years ago, I was shocked, but I believe this to be true because multiple physicians have told me this. You let's say you run a study, vaccinations is a great study. You run a study and you run it once and it fails. You do not need to publish it. You run it 20 times. One of them meets the hypothesis that you tried to test. It is completely acceptable for you to only submit that one test, ignore the other 19, and get that one published. That is a problem. That is a huge problem. Yeah. So most physicians will agree that that's a problem. What are we doing about this, right? So this is where there's a need for people like us, actuaries, to step in and say, hey, what if you look at all the data there is? We need to actually collect that data. I know I'm an insurance nerd, I get it, and therefore I keep going back to data, right? But this is where we can help and say, as actuaries, we understand the statistics, and not only is it the case that we can help resolve the data, we understand the value of missing data. We've seen this before. We've seen this problem before in a different context, right? And we are the ones that can kind of raise a hand and say, hold on, are you really sure that this is the complete data set we're looking at? What is missing here, right? We understand what it means to work off of biased data sets. In my example previously, 95% of the data is missing. We know what it means to work off a data set which only has 5% of the data, especially if that could be biased data. So there's a huge part for actuaries to play. Now, the other side, and my wife tells me this all the time, facts do not end up solving an argument, right? The emotional component is a big piece of it. You cannot ignore it. So you have to understand not just what the data is telling, but what is the true need? What is the social need? Where from a community are we coming in here? So many other things get politicized, right? COVID became politicized. Are we making sure that we are understanding not just one side of the argument, but are we opening our ears and listening to both or multiple sides of the argument and bringing that in? So bringing that business solution in, bringing the ethical solution in, bringing the emotional solution in addition to having data support that answer. Absolutely, actuaries can play a big role in that. Certainly, we would not be doing it alone.
Oh, excellent. That's a great answer. We covered a lot of different areas there. We got one more question. Do you think it's necessary for actuaries to learn all of the various advanced analytics and all the algorithms and new techniques? That's a specialty that's outside of our core duties. And do we believe that it should become a part of our core duties? I can take a first shot at that one. And I would say that there's still a lot of different specializations even within the term of pricing actuary. So there are certified specialists in predictive analytics, which are more modeling focused. Those are probably going to be the types that are in tune and using these advanced techniques, and others that aren't. Maybe more of the traditional actuaries that do the typical indication analyses and those things that don't always have those robust algorithms. So I think there's a place for a variety of different types of personalities and skill sets. I don't think we need to be experts in every single one of them, but we should be aware of how they're being used and the key pieces, of the data that's being fed into it. Data is data, and we know what are the weak spots, where is it biased, as you're saying. If there's missing data, how do we understand that? And that's going to be a key in any sort of algorithm that goes into it. So I think there's some key components that all actuaries can be aware of, even if we're not experts in every single type of algorithm. Aaron, you have any thoughts?
No, I think I agree with that sentiment, Mike. My experience on this has been back in 1998 and 99. I studied abroad. I went to England and University of Sussex, and I studied artificial intelligence there. Now, this is more than 20 years ago. It's not the same artificial intelligence that we do today, but a lot of the theoretical understanding I got from there. And it was great because You see the overlap between what was happening in the AI ML world with what's happening as pricing actuaries. You absolutely see it. The ID brand segmentation, and that has made a huge difference in the insurance world. Being able to understand from a theoretical perspective some of the core issues is huge in asking the right questions. And what I have found most successful is doing exactly that. Now, I actually did a lot of GLM predictive modeling work at one of my prior employers for about 3 years. So I run these models myself, and I learned a lot from it. I learned what the power of these models in insurance, and I've learned some of the holes that these models leave. The best answer, I think, is having actuaries and data scientists work together. That being said, going back to the way the question was originally asked, I would kind of take a little bit of, I would take a different take on that. I don't think it's the case that actuaries are, that it is not our core responsibility to run these models and to understand them. And the reason I say that is we are supposed to be, as actuaries, when we price something, we are supposed to be accounting for all risk factors impacting those prices. Inherently, that means anything to do with predictive modeling, running GLMs, running neural nets, deep learning, all of those are ultimately answering that same question: is what are the various risk elements that are impacting the price? So I think it is 100% core to what the work that we do. Traditionally, when I say traditionally, I'm now going back 20, 30 years, we did not either have enough data or we did not have the computing power to be able to run models at that level of complexity that we can do now. The computing power now is insane compared to what that was even 5 years ago. So going back 20 years ago, historic time at this point, right? And so that's where a lot of those core actuarial principles were developed. I think they still hold true. But they have to be looked at in the light of what's available now. Right now, if we are using algorithms, whether it is, I almost say something like a GLM, generalized linear model, is 100% part of what an actuary should be able to do at this point. Once you start stepping into neural nets and genetic algorithms, that's where you get into areas that probably I would not expect most actuaries to know. But again, that's where we should be able to step in and ask the right questions. We should be able to check and validate that the results make sense. We should be able to read the outcome of charts that lift curves, double lift curves, that show what an algorithm is doing, and being able to kind of ask questions and say, that doesn't look right. Something about that doesn't look right to me. Let's investigate this more. That should 100% be our role. If we are not doing that, I would go as far as saying that we are not we're not doing our role if we are not asking those questions.
Oh, excellent. Well, Somil, I think that's about our time. Thank you very, very much for joining me today in this AAIS Pulse session, and I really appreciate your time.
Mike, thank you so much for having me. I really appreciate it. It's been a great conversation. If you have any other questions, feel free to reach out.
Great. Thank you very much.
Mike.
All right.